This conference will now be recorded.
So today we enter day one in our discussions of the master budget process, which is your major takeaway. Now you remember in financial accounting, your major takeaway was learning to prepare the financial statements. So in managerial accounting, the major takeaway is completing the master budget. So what is the master budget and why is it important? Major issue facing most companies is month-to-month liquidity. So even though you might have a profit, because your receipts and disbursements vary during the year, and a lot of times profits come in the last couple of years, you still have to pay your bills. So just like you personally got to pay your rent every month, I don't care what might be coming in, and pay it at a certain time, a company's got to pay its rent, it's got to pay its employees, and it has to do that every month. So let's look at what's involved and what we're trying to do is to say, given some assumptions that we have, do we have enough money to pay our bills? And we're on a quarterly basis here. In actual practice, it will be monthly. And if we don't have enough money, the key thing is we take our statements to the bank and we get a working capital loan or a temporary loan so that we can monthly, quarterly have enough money to pay our expenses. So at the end of the year, we're still open for business. You'll see a lot of time businesses in the malls and everything shut down. Well, they didn't plan this and then got with a banker for money they needed ahead of time, and they don't pay that rent. Just like a few, they're gone. So we're gonna have a budget period. We're gonna be using quarterly. We have a selling price. We're gonna have the sales units by quarter, collections by quarter, total expenses by quarter, both fixed and variable, and a beginning cash balance and a desired ending cash balance. So, and when we look at these assumptions, you can see that the assumptions are that we sell 20,000 units quarter one, 20,000 in quarter two, 20,000 in quarter three, and as with most retail businesses, quarter four is when all the sales come in. We're selling at $50 a unit, and all the sales are cash, so we're making this simple. Our beginning cash balance is $100,000. And our books, our variable cost is $20. So we're selling these books at $20 each. So the selling price is $50, cost is $20, and all the purchases paid in cash. Then we got rental expense, and which is our selling expense. I just made it rent to keep it distinguished. $1 million a quarter. So every quarter, 1, 2, 3, and 4, we got to pay $1 million. And we want a desired 100,000 in the bank. So we need to prepare a budget to lay this out quarterly to make sure we're going to have enough money. So can we do that? Can we prepare a budget quarterly to accomplish that?
Yes.
Okay, so we can prepare. So prepare this budget for me then. Prepare this budget for me.
I'm sorry, Dr. Wood. I'm driving right now. I'm almost home.
Almost home.
Yes, almost home.
So we gotta wait for you to get home.
Well, where's everybody else at? Not you, LaKenya.
No, I'm not saying anything. I'm just laughing. I didn't mean to hit that button.
Okay. But just never come up when I want them. So let's see if we can.
Professor,
Yes.
is there something like on Blackboard so I can look at the same thing on my computer, or is I can only look at that through the GoToMeeting?
Can anybody answer that question?
It's in course
Well,
content.
what is it under is what I'm asking.
Master budget. It's at the bottom. Should be.
So we're helping a sister out.
Okay, I found it. Thank you.
So let's see if we can paste this in here. Okay, so let's begin to work on this budget. And what we do is we work on the budget quarterly. So we're going to start with quarter one. And we're told how many are going to sell in quarter one? 20,000 units, correct?
Correct.
Selling price? It's going to be what, $50?
50, right.
And so our total sales are going to be what in that first quarter?
I believe that's 1 million. Is that not?
You must not want to be a millionaire if you're guessing about $1 million.
Well, no, I mean, I'm trying to look at your screen as well, and I see nothing but zeros. So I'm assuming that there's a 1 before those
It's
zeros.
1 million. Yeah.
Okay.
And we said our beginning cash balance was what?
100,000.
Okay. So we got cash available of what, 1,100,000. Everyone see that? Okay, so if we sell 20,000 books, we got to buy them and pay for them. And we said these books were costing us what?
400,000.
Well, how much did each book cost us? How did you get 400,000?
Well, I'm assuming that was the total of all the books together. But for each one, I'm going to make I'm going to ask for someone else to.
Why you come, Dansby? They don't know
I'm
how
sorry?
you got 1,000. They don't know how you got 400,000. They want you to explain it. How are you bringing to get 400,000?
I got 400,000 from you.
So we got 20,000 books, and the books cost how much each?
It
Aren't they
costs
$20?
50 each. No, $50, I thought.
We sold them for 50. They cost 20.
Okay.
So we got to buy 20,000 books at $20 each. So that's how we get 400,000. Does everyone see that? And then we got to pay selling expenses of $1 billion, which is at rent. So your total expenses are $1.4 million. But you only got cash of what, $1,100,000. So you are in a deficit position of 300,000. Okay. So what you gonna do?
You have to borrow.
Okay. How much we gonna borrow?
300,000.
400,000.
Why 400?
400,000. Why 400,000, Jenkins?
Cause you gotta stay at 100,000.
You gotta stay
Your
at
ending gotta
100,000.
stay at 100,000.
Gotcha.
So if you gotta have 100,000 here, then you gotta borrow 400,000. And if you don't borrow this 400,000, what's gonna happen? Let's go on some more. I'll let you all do the next column. How many are we selling in the next column?
$10,000.
Only selling
I
10,000.
mean, 10,000. I said dollars, but 10,000. In the next
Here, and eventually 160,000. All right, so when we sell 10,000 at $50 each, let me just copy this. So we're going to eventually get to 200,000 books, right?
correct.
So what's it going to look like in quarter two?
500,000.
How'd you get 500,000? $50 times 10,000, right?
Correct. Yeah.
Then we have the 100,000 that we bring up from down here, so we still got 100. So now we got 600,000. But what are our expenses going to be?
The cost of books is 200,000.
How did you get 200,000? How'd you get 200,000?
We
Multiply, because each book costs $20 each.
Right. So it's
And
going
so
to
you
Yeah.
have to multiply it.
times 10.
So we did 20 times 10, right?
Right.
Right.
Okay.
I got you.
These selling expenses still $1 million. And they're going to stay that way all the time. So here it is. This is kind of like rent. Every month, How much we got. So now our
So that's
total,
like your fixed cost?
that's your fixed cost.
Okay.
I don't know if that's your fixed cost. So how we stand now at the end of this quarter? $600 available, expenses of $1,200. So is that a minus $600?
It is.
So how much we got to borrow this time?
700,000.
We can still have 100,000. Still the same number in quarter 3. So what's
Quarter 3 will be the same as
It's the
quarter 2
same.
for the most part. Yeah.
500,000.
we got 500,000. Beginning cash of 100,000. The books are gonna cost us what? Same thing.
$20 each, so that'd be 200,000.
So we're down what?
Same thing. Yeah.
So how much we got to borrow now?
700,000 still. So we can get 100,000.
All right. Now, do y'all think y'all can have the big fourth quarter?
Maybe.
We can try it.
$8 million.
How'd you get 8 million?
160,000 times 50.
Okay. Still got 100,000 down there that we bring up.
Mm-hmm.
So now how much cash you got available?
8,100,000.
How much our books gonna cost?
3,200,000.
Rent stay the same. So our total expenses now what? $4.2 million.
Mm-hmm.
And how much excess cash you got left over?
3,900,000.
How much?
3,900,000.
I take your word for it. So all we did was we had cash available of 8,100. We subtracted 4,200. So now we got this cash of 3,900. So what we're gonna do now, since we have cash, we're gonna pay off these loans. How much should I get?
3,900,000. You had too many zeros, so I'll correct it. Yeah, there you go.
So we need to pay back our loans. How much we got in loans?
1,800,000.
Yeah.
So what's our ending cash gonna be?
It's always be
1,000,000.
100,000, right?
2,100,000.
So it's not gonna always be 100,000, despite the fact that The rest of them more?
Say that again?
Am I echoing for you?
Yeah, that's okay. Go ahead.
Oh, okay. Now I was just asking. So it's not gonna always be 100,000, even if the other quarters are 100,000. Correct? The only thing that's gonna be the same would be the beginning cash. That's the only fixed amount.
Yeah, I see what happened. In this case, we borrowed 100 to stay at that, but then in the fourth quarter, we're at 2,100,000. That's just how the facts are working.
Okay. All right. Gotcha. Thank you.
Okay. Now, the key thing is that if you didn't have this borrowing set up ahead of time, your business would have been thrown out in the streets and you would have never gotten to the fourth quarter. So, every major retail company that you see prepares a budget like this and takes it to the bank. And they tell the bank that if you work with us, this is how our income statement is going to look at the end of the period. We're going to have sales of what? What are those sales going out of sum to? 10 million, right? Then they're going to say their cost of sales is how much? Yeah. 4 million, right? Okay. So the cost of sales is what? 4 million. So our contribution margin in dollars, so our CM in dollars is what? 6 million? Then our fixed cost is going to be what? The selling expenses, and how much are the selling expenses?
4 million.
4 million. So our net income is what?
2 million.
2 million. And so the retail company is going to take his cash flow by quarter to the bank, along with his net income for the year. And is the bank going to loan him the money? They probably will. They'll charge interest, but they say if this is where you're going to be, then we loan you the money. So this is what most companies do who want to stay in business.
So, like the accounting people, whoever is over the accounting department in this company will prepare these statements and take it to the bank.
Yep.
Okay.
If not, finance people. So a combination of accounting, finance people, your budget people.
Okay.
Any questions?
It wasn't so bad.
Wasn't so bad.
It wasn't.
Calculate my break-even sales then.
Okay.
Target profit
So what would the fixed cost? Oh, well, the fixed cost will be. Would I treat $100,000 as the fixed cost,
You got to make a decision
or
based
do
on
I
all
add
that
a
y'all
hundred thousand? So
determine.
do it 400,000. Well, you know what? I'm looking, and it's no, I don't know.
What you looking at? You got to be able to apply what you learn.
Right,
I,
but if the fixed
I
cost
want
was 100,
I want the break even sales. I want a target profit of $1 million sales.
I'm sure you do, Professor. But what I'm asking you is to do it. You know, you do fixed cost divided by the margin. Would I take $100,000 as my fixed cost, or what?
I doubt it.
Okay, would it be a 1 million?
Yeah, you see this number here? That's fixed cost. Let me bold it.
Oh, I'm not, okay. Never mind. I'm looking at the top.
I'm gonna bold it and make it bigger for you.
I was looking at the top, and I'm looking at my computer. Okay, I can do it now.
Bold it and
You do
make it.
not have to both. Okay.
Then I'm gonna come up here, and I'm gonna, you know, and so remembering what my professor taught me last week.
Okay, so we would do 4 million divided by.
Remember what my professor taught me last week. That's what I'm gonna do.
Right. I wasn't paying attention. I was looking up at the
You weren't
top.
paying attention last week. Thanks for telling me.
I was paying attention last week. I'm saying I was looking at the top, like with the unit expenses, and not looking down by sales.
So my professor last week told me always to, that professor y'all had last week, always do stuff based on one unit so we can get stuff clarified out.
Mm-hmm.
So if I was doing one unit, what would the selling price be? Everybody answer one.
$20,000, right?
No.
One.
50.
Uh,
Thank you.
50,
And
yeah.
what's the cost of one?
50.
We said the cost and
20.
selling price can't be 50 now.
20.
20. Are you still celebrating your birthday or something?
That I didn't say that. Okay, so maybe everybody is a little confused because how it looks. It looks very different from the homework we just did.
I don't know.
Well, I'm telling you, that's
So,
my problem.
so when things change up, you go back to basics. The
Right.
professor
I'm looking at my notes.
work with one, you get the selling price of one, you get COGS of one, and then you got what? The CM for one. So what's the CM for one item?
30.
Thank you.
Oh, and that's what that
You
will
know, on
be
a
the.
basis, your sales for one is 50. Your
Mm,
variable cost is 30, so your CM is your COGS is 20, so your CM is 30. Can y'all
I would.
calculate break even quantity now?
Yeah, it's gonna be.
Does it look enough like it?
Yeah, 133,333.33.
Let's see. Let me make these bigger. So you said if you put it in the form, you get what? sounded right. How much was it?
Oh, 133,333.33.
So we'll just make it at 133,333.
Mm-hmm.
And how many you need to sell and make a profit of $1 million?
Okay.
Just look different.
666.67.
Any questions? Can everybody do that? Buford, maybe you better tell them how you did it.
Oh, well, I just used the target formula, and that's fixed cost plus, huh?
You might need to tell them the break-even formula. They may not even have that.
Oh, I'm sorry. The break even formula is fixed cost divided by contribution margin. And the target profit formula is the fixed cost plus the target profit formula. And the number for that was 1 million. So you do 4 million plus 1 million, which will give you 5 million. Then you take 5 million and you divide it by the contribution margin. And then you'll end up with that number.
Y'all got it? Is everyone happy? From
Yes.
Look,
Professor?
Target
can you say that? Can you
target
say
price
that
plus
first formula
fixed
again?
cost.
You guys say it again, Buford.
I can't hear what he said. What did you say?
I said, can you say that
He
first
wants it.
formula again for me, please?
Oh, the first formula, that's the easiest one. It's just fixed cost divided by contribution margin. That's it.
Mm-hmm.
And that's how we ended up with that number by doing 4 million divided by 30.
Now you said that's break even formula.
Mm-hmm.
Okay, and then what was the other one you said?
The target profit formula is when you do fixed cost plus target profit. In this case, the target profit was $1 million. So normally you'll have a number, and he's been using $1 million. So when you do that, you do your fixed cost plus the target profit divided by the contribution margin. And the fixed cost was 400 million, 4 million, and the profit was 1 million. So you add that 5 million divided by 30, and that's how we got 166,666.67.
Okay, thank you.
Professor, you're supposed to have another 6. Oh, did you just round that at the end? Okay, never mind.
So let's come over here, which is what you're supposed to be doing these days. On Excel. Let's see if we can write a formula for this right next to it. Equals what?
Um,
Parentheses.
mm-hmm.
And we're going to
Fixed
click on
cost.
fixed cost. Then we're going to have what? A slash, right?
Mm-hmm.
Then we're going to click on what? The CM unit, CM. Look at that. Does that look good?
Yes.
All right, so give me a formula for this next one.
You're gonna put equal sign parentheses.
Hit 4
4
million.
million plus the 1 million. Well, Can we do
Can you
it
go at the
because
top and use that 1
1
million up
million?
there, or what?
I'll put it right here. So I'll put a
If
million.
not, could you use one of those cells at the top?
Wait a minute. What happened here? Go back. Trying to put a million in here.
It's because you're already in the middle of the
Yeah, it's not letting me.
Yeah.
the formula. So
Do
you
it
have
at the
to.
top. Do cell. You see the one up there from the expenses? Just hit that cell. Is that what, D4?
Because you all gonna have to be doing this, we just need to put it in a separate box. So target profit of $1 million. So we got $1 million here. So we got equal, shift parentheses. Now the fixed cost plus
Parentheses.
parentheses. Put a slash.
Backspace. Slash 30.
It doesn't want
Maybe we need to put another parentheses in the beginning to separate the two. You know what I'm saying?
to. Yeah, it would do that. I thought it would. You want another parentheses?
Yeah. Yes.
About fixed costs.
That plus the 4 million.
And a parentheses.
Close your parentheses.
Slash.
Yeah. And then click another parenthesis. Yeah. There it goes.
So, writing your formulas to do this.
I can't really hear you. Hey, look, can you turn your mic off, please?
Okay. So we had a small retail business, this is all we'd have to do. But if we have a manufacturing company, a little more involved. So for those businesses that we're making, when you get ready to do a master budget, you're going to have a sales budget, production budget, selling administrative, manufacturing overhead, direct labor, direct materials, and a cash budget. Then you're going to have a budget and income statement and budgeted balance sheet, and they're all going to tie together. So one of the big things is, making sure that we can prepare a master budget that ties in. You can't just throw numbers down. There needs to be a tie given once you do these budgets, you can prepare a cash budget, and then you can prepare a budget and income statement and balance sheet that ties in by looking at all of these budgets. And we have an in-class problem. And so let me pull out of this for a second. And so with this in-class problem, we'll just assign everybody a budget. Won't that work? We will assign everybody a budget. So let me see here. Let me go ahead. Let me see. Okay, for our quantity solution, and that's the first thing we have to do what we were just doing. Dansby, you seem like a good person for that.
Okay, gotcha.
And I know Buford wants the sales budget.
Just lovely. Got you. Hi, Professor Boyd. Can you give me a part, please?
Who wants a part?
This is Alicia Barlow.
I'll give you the production budget, Barlow.
Production budget?
Yeah.
Okay.
No more missing class for you and other people too.
All right, I got you. So when is it due?
Next class period.
Okay, I'm just making sure. Thank you.
So you all would need to get together as we do all of these budgets. So Barlow has a production budget. And so, let's see, Jenkins will give you raw materials.
All right.
Labor, we'll give that to Dansby. I have to make sure I got enough budgets for everybody.
I thought you already gave Dansby something.
Yeah, I have like quantity.
I did get
Yes,
that.
quantity.
Yeah.
Well, we'll give that to DM, Music High, whatever. Is that right?
Close enough.
All right.
So you gave her labor or?
I gave her labor.
Okay.
All right. McCaskill, manufacturing overhead. Let's see. And we'll give Clifton selling expenses. I know she likes to be involved in a lot of sales.
That's right.
And Kiara will give you administrative expenses, okay? Did I leave anybody out?
Okay. Administrative expenses.
Did I leave anybody out? Okay, so, well, Dan, we'll be back to you then during the capital expenditure budget. So,
Okay. So I have quantity, or so I have two budgets that I gotta do, correct?
we'll show you what's involved.
Okay.
Can you share the screen? Yeah, I was just about to ask.
So you have your name by this problem. I'm only going to get 1 grade for the problem. All right. So everybody got to do their part. So let's talk about what you do. So, Dansby, let's just say table. So, Dansby, you'll be doing something like the quantity solutions, okay?
Okay.
So this is just what we were doing, selling price less cost. You put those items in, then you kind of prove them. Take these out because you'll need yours. But you prove them, and once you get your quantities, you send those, and they're right, then you're going to send your quantities to Buford. Then Buford is going to do her sales budget. So this tells you everything you do. And to get to a cash budget, an income statement, and a balance sheet, there's 2 things that are happening, not with the first budget, but you're doing 2 things. You're determining how much is going to go on the cash budget, and then you're making journal entries. Okay. And so as you make these
So I have to
journal,
make those journal entries.
yes,
Okay.
and as you make those journal entries, we know that if we can make journal entries and post to the ledger and get a trial balance that balances, then we can get these income statement and balance sheet. And everybody right now, you're just doing 1 budget. So, and we'll tie them together as we look at them. So all you gotta do is read your section and it's telling you what you need. Now for the production budget, there are no journal entries. These are just quantities. But once the production budget is done, then the production budget information goes to raw materials and labor, and they use that to make their calculations. And then
Question.
here, for the production budget, your journal entries. Labor, here's your journal entry. So all you got to do is look at your section and work on your journal entries. Then for
Hey,
manufacturing
Professor.
overhead, here's your part. Then for operating expenses, selling expenses, here's yours. Here's 1 little journal entry. Then here's administrative expense. Then we get back to the cash, but no, the capital expenditure budget and a couple of journal entries there. So Dansby, you'll get to make some journal entries.
Okay.
Okay, so let's look at our problem, and this is in your information. These are our assumptions. The quarterly sales are 10, 20, 30, 40, and 100. We got a selling price of 100. We got credit sales of, all the sales are credit. The bad debts are 20%. And we collect 50% in the month of sale and 30% the month after sale. So we make the sales. And these will actually be quarters. Our desired inventory is always 50% of the next month's sale. Then we have 2 ink cartridges, 10 and 20. Paper, 4 and 8. And so, Jenkins, you have 2 budgets you're working with since you got their 2 raw materials. Then we pay for the raw materials 75% of the month of sale, 25% of the month after sale. The workers make 10 books per hour and they're paid $20 an hour. Okay. And Here's the overhead with the depreciation. Here's selling expenses, 20%. Administrative expenses, including depreciation, initial cash balance. So the initial cash balance is 100, and you got to maintain 100 also. You purchase equipment with a note. So these are all of the assumptions that we're working with in this problem. And so you pick out the parts of this that relate to you. So here is our master budget quantity solutions, Dansby. So let's see if we can get you started. It said the selling price is what?
All right, let me scroll up. Selling
$100.
price is 500. Yeah.
$100. Okay, getting them started. Now you're gonna put your variable cost in. I'm gonna go up here and put a couple of them in for you. The raw materials, ink is 20. The bad debts are 20% of the selling price. So your bad debt is 20 also.
Okay.
And so you just go in that information and get your unit variable cost for your total variable cost. Then you're gonna get your contribution margin. The fixed costs are always manufacturing overhead, administrative expense, and interest expense. So what you do, all you're concerned about is the total overhead. So that was 100,000. Here's administrative expense, and here's your interest. So I'm gonna go on and put the manufacturing overhead in for you. So that's 100,000. So I've done a lot of your work for you.
I have a quick question for you.
Yes.
So, will you upload this in course content? Because the one I have in front of me shows different numbers, like 10%, 20%. The selling price is $500 on here, and so all my numbers on here that I was actually looking at is completely different from yours.
I'll make sure it's the
That's
same.
true.
And so
That's true.
I got confused about
Well,
the
use your numbers.
documents.
So
I'm
mine
sorry.
are, so use your numbers.
Okay, gotcha.
And you got the same numbers, Buford?
Yes.
500 and everything?
Mm-hmm.
Good.
Okay, Professor, I'm on this slide that you told me to go to, and it has 33 page slides on there. And I'm trying to find where y'all are looking at, but I cannot find it. So can you please help me and locate me to the right direction?
Are there page numbers on there?
No, it just says slide. It just says slides. It's like 33 slides.
Look like you're in
I went to,
PowerPoint. It's in the course
yeah.
content. The name of it's called Master Budget Insert Spring 2021. It's a Word document. There's only 21 pages on there. And where we're at 13 out of 21 right now.
Wait, the master budget or processing costing?
Master Budget.
Master.
Yeah.
Okay.
Someone told me the last one. Okay, bet. Thank you so much.
So we're on 13, page 13, all right?
Great, thank you.
Mm-hmm.
So Buford,
Yes.
let's look at a situation that I'm familiar with. We'll go to a Excel sheet in a second. But Buford, suppose you come to TSU in August. There in August, and you get ready to pay your bill, and your bill is $10,000. Okay, that's your
Okay.
and TSU. So you owe TSU $10,000, but they give you the option, and you take that option. So in August, you pay half of it, $5,000. Okay. Then when September rolls around, I had too many zeros. I got too many zeros. You pay 50% of what's left. So that should be a situation most people are familiar with, correct?
Yeah. So in September, I'm going to pay $2,500. Yeah.
And then what you gonna do in October?
Pay $2,500.
Okay. So how does this look from TSU side? Well,
What do you mean?
you're the accountant for TSU, the finance person for TSU. So TSU might make an entry, what? Debiting cash for $5,000, account receivable for $5,000. They credit tuition revenue for $10,000, right?
Correct. You
They,
said cash for 5,000. You said accounts receivable.
yeah, you'd owe them. You'd be a receivable for them, wouldn't you?
Yeah, that's true.
They put 5,000
Yeah.
down and credit the tuition revenue. They're gonna credit it for $10,000, but they don't have all of it, correct?
Right.
So they made the sale to you of 10,000. Still got extra zero, but they don't get their money till when?
October. So there's no interest.
Yeah, but we aren't talking about interest. All right, so that's just something you want to be aware of.
Okay.
We work this problem. All right, well, let's go to the numbers. You say you had a selling price of what?
Let me go back.
Y'all go back to the numbers y'all have. So I'm supposed to have hard copies. So what's selling price, Dansby?
Selling price will be $500 for this document.
All right, we're doing your document. How much is the ink?
The ink, it says, let me see, where is it at? 5 ink cartridges per book. Now, in the second quarter, it says $10 unit cost.
So that's
But the
probably
first quarter, I'm sorry?
that's probably $50, right?
Right.
Okay. And what's the bad debt?
All right, let me see. It's a lot of letters, so I have to, yeah. Try to keep from going cross-eyed while looking at it.
Didn't I tell y'all to make a copy of this? A hard copy?
Yeah, I'm looking at mine because mine's printed like double.
Yeah, and it's not, the issue is that it's just a lot of letters, that's all.
All right. So what's the bad debt? I'm just trying to help you out. What does it say about bad debt?
Still looking for it. Let's see, payments, and direct labor.
I mean, what's the rate bet? I mean, how many they collect, Buford?
You said how? So the
I
selling
just
price is 500 in the collection.
yeah.
It says 40%
Month of sale.
month of sales.
Yeah. And then 50% first month after sale.
So the bad
Yeah.
debt.
So this what I was asking you about.
So the
What
bad
I was
debt.
asking them.
The bad debt must be what? 10% of this number of 5. I don't want to do all your work, Buford.
Right.
No, on
You,
Friday. I was asking you this. So 40%, will we do 40% of 500?
No,
Can you
right, but
explain that?
you just went. You said it was 10% then. So are you going from the quarterly sales percent?
90. Then 10% is bad. 10% is selling price.
Okay, okay, this is the part that I'm confused on. Okay, so it starts off saying quarterly sales percent, which is 10%, right?
No, you're not on that yet.
Okay. What we're on is 40% month of sales, right?
I'm trying to figure out the bad debt expense. So if I'm getting 40% in 1 month and 50% afterwards, then 10% of the students not paying, right?
Oh, got you. I see. All right. I see
That's
you about that.
I figured that.
So the quarterly sales percentage, we just gotta ignore that for right now.
Right now, we're gonna come back to it in a second.
Mm.
Okay, so you're gonna get your total variable cost and a contribution margin. How much is your manufacturing overhead total?
25,000? Oh no, you
Yep.
said total?
Yeah.
100,000?
How much?
100,000.
Okay. So dance, you're gonna go through and do this for both years. So you got the target profit, target loss. And that first one should be a target loss of 100,000, okay?
Okay.
So first year, target loss of 100,000.
Right, and it's up there as well.
And then the next one is break even.
Correct.
So you're gonna knock all that out.
One quick question. How did you get $50 for bad debt expense?
Okay. We're collecting 40% in 1 month and 50% the next. That's 90%. So 10% of the people not paying. So I simply took 10% of 500.
10% of 500. Okay.
Okay, selling price.
Let's assume, Buford, that he goes through these calculations. Let's assume he gets 10,000. I don't know what he's gonna get, but let's just assume he gets 10,000. Okay.
Okay.
If he got 10,000, you would put 10,000 right here as total sales quantity. Try to make this stuff larger. It's not gonna get any larger. Do we get larger this way? Oh, the stuff's acted up. Let's see if I can escape. Assumptions. Oh, it messed up all my tables.
Hit the back button. Just keep going back.
I'm not going back on this one. Maybe it will.
Go to like assumptions and journal entries down there. Like click out of go to a different sheet and then go back to tables.
There we go back again. Y'all just have to see this. Make your screens larger. Now, Buford, what were those quarterly percent you had that you were excited about?
The percentage says 10% for right there.
10% in the first quarter,
Then for sales, there's nothing there right now. But for
I,
selling price,
I'm not worried about that yet. What's in the second quarter?
oh,
That's
20%,
20%. Yeah.
What's in the third quarter?
30%,
And what's in the fourth quarter?
40%,
Okay.
40%, and a total of 100%.
Okay. So it's 100%. So what you're going to do now, Buford, is what?
The selling price or the sales?
You're going to get your quantities first. Your selling price,
Okay.
you get $500. So let's put that in. If you want to put that in.
Okay.
Go on and copy, paste these sales all the way across. Cancel. Okay. So y'all got to create y'all spreadsheet. I just copied it in here. All right. So how many are you going to sell in the first quarter? What's the quantity going to be, Buford?
1.
You mean 1,000?
1,000.
Then maybe 2,000?
Yeah. Yes. Well, see, I
Then
just took a
3,000?
guess on 1 because we don't have numbers in ours. Why did you say 1,000?
I just took 10% of 10,000. So when I get the number of the quantity, when he gives the number,
So you took
that
10,000 from
I said
at the
assume
top?
that his
Oh, sorry.
quantity was 10,000
Okay.
for a target loss 100,000. Then the 10,000 comes here, and now you breaking those sales down in 10,000. So then you'd have, I guess, 4,000 here. Let me see if that's gonna work. Yeah. So the purpose of the percentages is to, once you know what the sales number is and you put it here, then you can break down the sales by quarter. That's going to be good if this quantity is correct, though. All right, so let's look at first quarter, Liz, since you're ready to go now. So how much is total sales going to be for the first quarter?
1,500.
How much? 1,000 times 500.
Oh boy, I'm off today. That's 500,000.
Okay. And all of them credit sales, okay? Now, the bad debts we said were 10%. So what that means is 50,000 is not going to be collected. So 50,000 of the money that the student said they're going to pay the university is not going to be collected. Now, in the month of sale, they're collecting how much? 40%?
Yes.
So they're going to
So
get
they connecting 40% of 500, right?
correct. So how much they getting?
They're getting 200,000.
And then in quarter two, September, they're going to get what? 50% of 250.
1 month.
Okay, because we just got one payment period. So in the chart, when they have the sale, they get 10% is bad. They get 40% in the year of the quarter of sale. Then they get the other 50% the next quarter. We'll see that.
Yeah, I see it. because you got that for this month, and 250. Half of it go to the second quarter.
And just to help you out a little bit, now suppose we did this again for the second quarter. So we got 2,000, so we'd have what, $1 million here, right? Right?
Yes, you have $1 million, and
And
it
if
will
we
still
have,
be. Go ahead. Sorry.
so what's the bad debt credit sales? How many people gonna not pay? But it's all credit sales, so
So it'll just be $1 million. How did you get $1 million for bad debt?
I meant to put that million here. What's your bad debt speed in?
Would that be
100,000.
our 40%, right?
No,
100,000.
100,000.
How do we get bad debt again?
10%.
10%, 10%. Okay.
So whatever your percentage is, I'll put it over here. You're gonna be doing 10%. Whatever it is, you're getting 10%. And it jumps back
Okay.
all again. Take that time. Okay, let's look at your collections in the second quarter, Buford. So if you
Okay.
sold $1 million, you're gonna get how much of that?
100,000.
You're gonna get 40%.
Mm-hmm.
And you got that other 250 from the first quarter. So what's your total quarterly collections for the second quarter?
Would it be 600? Yeah, 650,000.
So you think you can finish this table now? Good.
But it will still be 250,000 for this side too, right? For 3.
It'll be 500,000.
You gotta go
It'll be
think.
500,000. You go back.
Yep.
You're kind of going
Why?
counter corner. You're going counter corner.
So you go first month, second month, first month, second month, first month, second month.
So 40% of the month of sale, 50% the next month.
Right. So okay, and you just keep going back and forth between 40 and 50, 40 and 50. Correct?
Correct.
Okay.
Now, whatever these sales numbers that are on this document, on the sales budget, we're gonna copy them, and guess what we're gonna do? We're gonna paste them on the production budget. So y'all need to do your own they're not gonna move on. So y'all create your own sheets, but hopefully you can see that. Whatever is on the sales budget, transfer it down to the production budget. Now,
Okay.
what's our desired ending inventory on your budget? What's our desired ending inventory?
Design ending inventory. I have 50% of
Inventory,
Desired.
desired ending inventory.
yeah, it says 50% of next month's sale.
Okay, so you got to produce what you're selling now plus 50% of next quarter because you got to have something on hand.
Oh boy.
So we got 1,000 in here. So see that bar left? You don't have any, so this is 0. So the units to be produced is going to be 2,000. So even though you
You say even the what?
even though you're only selling 1,000, you want to have half of these on sale, so you have something to sell on the first day of the month. Got it?
Mm.
So in the
But I
second,
thought you said 50% of the
yeah,
sales.
of the next month's sale, you gotta have all of this. You can't sell these if you don't have them. But then you got to have 50% of these too.
So
So
we gotta
if
have 50%.
50% of the
I'm
sale,
kind of confused.
you're running a company, you want something to sell on the first day of the next quarter. The only way you're gonna sell it, have it available, is you producing
If
it.
you have it on the first quarter, okay. But why did you use 1,000 for desired inventory for the first one? Just because
50%
1,000 is
by quarter.
50%? Okay. I
Let's
get
go.
it.
Got it now? Let's go to quarter 2. You got to
Mhm.
produce this 2,000 plus 50% of quarter 3, so this would be 1,500.
Mhm.
About 35.
500. With a zero?
No, you already got
No, no,
1,000.
no, no. We have that, so it would be 1,000, right?
Let me see. Yeah. Let me go back up to 3,500. But you had 1,000 already made. So you only got to produce
2,500.
2,500 that second quarter.
Okay, I get it.
Good. So we'll stop there in terms of the production budget. But guess what? These first two numbers, all these numbers on the production budget, we're going to copy them and we're going to put them on the raw materials ink budget. And we're going to put them on the raw materials paper budget. So they need to be correct. So these numbers need to be correct. So the production budget needs to be finished to be correct. But since these numbers come from the sales budget, then the sales budget needs to be correct. So this number needs to be correct. So if this number needs to be correct, then this number needs to be correct. So if you make a mistake here, there's going to be a whole lot of things wrong back here.
I know. I appreciate you giving me, the more crucial part. I thank you for that.
Yeah, that's why I gave it to somebody who could handle it. Couldn't just give it to anybody.
All right, I appreciate it.
Okay, let's see if we can do manufacturing overhead. Who has manufacturing overhead? Speak up or forever hold your peace.
I had it, but I already know for sure that I'm not ready. I got some
Oh,
videos
okay.
to catch up on
How do you know you're not ready? Let's
because
help you get ready. What does the assumption say that manufacturing overhead is? Go
all I
to
see all I see is my steps. Let me
no, go
see.
to the in-class problem. Assumption. What does it say the manufacturing overhead is?
I don't think I see what you want me to read.
Buford, can you see it?
What you looking for? You want the assumptions for
Total overhead and quarterly amount.
um total.
So this is not supposed to be a hard one.
You said I'm looking for the overhead?
Manufacturing overhead.
Well,
Oh,
because I'm
100,000?
right, about to say what I have is 100,000. I'm assuming that
Yeah,
ties into his. That's
yeah.
100,000.
Or
So
unless you're doing it quarterly, then it's 25,000.
each time.
Yeah, so it
That's right.
depends.
Yeah.
All you got to do is put 25,000 down, so you are ready. So then you've got to subtract out depreciation because that's not a cash expenditure. So how much is the depreciation?
Um,
$10,000.
Quarter,
Depreciating including and manufacture overhead 10,000.
a quarter, right?
Mhm.
how did you get that?
It's on page 12 in
Yeah,
my
it
sheet.
has all the list
It says
quarterly
class
and
one
quarterly.
problems. It
All right.
tell you. It's in a little table.
So this will be 40,000. And I'll just do the first one. The first amount is what, $15,000. That is, you don't have to pay 25,000. You just got to pay 15,000. Who has administrative expenses? It works the same way. So that is a very easy one. It's not tied to the
I
other
have
numbers.
administrative expenses.
So that you should have no excuse in terms of not having it done correct. It does not tie to the other numbers. So there are a couple of these that are difficult, but after that, then they're pretty much the same. Okay, so then we'll pick up here next time, and we want to go through this budget. And then the bottom number, you have payments and receipts. So they're going to eventually come to this cash budget so we can determine whether we need to borrow money or not. So it's the same thing. So
Professor, can you I'm sorry to interrupt
every
you. Can you go back to all the names? I want to take a screenshot of it.
you want the names.
Mhm.
Here they go. Dansby, Buford, Barlow, Jenkins.
Got it.
So I'll try to copy and put it in assignments too. But only one grade, so y'all need to have it right.
I just put it in our group me too. So
That should help. That should